Welcome back to K-Ratio's Week in Preview. I'm Kyle Littner, and I'm here today to provide actionable insight for the future, not recap the past. In this week's episode, busted brackets, broken supply chains, and reefer rates out of control. March Madness continues. We'll break down what that means for you this week, but first, let's take a look at where the freight market currently stands. The National Outbound Tender Volume Index continues its streak of days above 15,000, with a 4% increase from last week, now at 32 straight days. And 15,898 is good for 36% higher than last year's pre-lockdown volume pushout. Tender rejections continue their streak of days above 25% at 40 days, now at 28.2%, a 2% jump from last week, and the highest rejection rate ever seen at this point on the calendar, well above 2020 in purple and 2018 in orange. Combining the two metrics gives us a freight load volume number that is an astonishing 15% higher year over year, despite the fact that we are moving toward non-COVID life at warp speed. Even with the jump in volume, spot rates did not increase on contract. In fact, the spread as measured by DAT narrowed down to 9 cents from 11 last week, as contract rates are moving higher. Checking that same chart for reefer gives us a 2-cent tightening of that spread as well, but spot rates increased 3 cents to $2.96 per mile, while contract picked up 5 cents to stand at $2.76 per mile. It feels like shippers are trying to get ahead of this impending blowup in refrigerated freight, but at this pace, it will be too little, way too late. We all know produce season is the next big thing on the calendar, and fans of this show know that West Coast imports, particularly the LA area, are at historic levels and have served as underlying support for the entire market. There is another event underway that now has the potential to disrupt capacity on the West Coast even further, and that is the great inventory rebuild. Major retailers are struggling to keep up with the seemingly never satiated appetite of the U.S. consumer, and this has a serious impact on freight. First, for context, here's our problem. Inventories expressed as a ratio of sales are at their lowest levels in 9 years. It doesn't matter if it's e-commerce or brick and mortar, U.S. consumers continue their buying spree and they want their goods now. We've previously highlighted the long-haul over-the-road aspect of this level of demand and that effect on capacity, but the typical inventory movements to DCs and warehouses still exists, and that's where things are getting tricky. A favorite destination for outbound LA freight is the warehousing market of Stockton. This chart displaying the outbound market share of Stockton in blue against the inbound market share in green gives us everything we need to know. Inbound exceeds outbound, this is normal, but the two should trend together. Currently, these two are out to their widest margin ever as carriers are delivering more goods to the Stockton market than they are taking out of it. A good thing for an inventory reload, but a bad thing for a carrier looking to get out of Stockton. And this is how inbound rates rise while outbound rates fall. Further proof of this market imbalance can be seen when comparing outbound tender rejection for Stockton in blue against LA in red. Typically, these two markets trend together as they are intertwined, but much like our previous chart, the two are headed in opposite directions and out to their widest margin on record. Anyone in Stockton is just looking for a load to get out. Just comparing the round trip rates between the two markets gets you an LA to Stockton rate nearest highest ever at $3.60 a mile, while Stockton back to LA is at its lowest rate since June at $1.60 a mile. We can now add an imbalanced inventory rebuild to produce season and surging West Coast cargo imports on the list of reasons why shippers will spend all of 2021 chasing runaway spot rates. What does this mean for freight this week? Carriers, California is the place to be. Dry van, refrigerated, it doesn't matter. And because capacity is short everywhere, you won't even take a rate cut going in. Getting out features an LA to Dallas average rate of $5,000, courtesy of $3.50 a mile. That's a full $2 higher year over year. Brokers, LA to Dallas contract rate is $2.90 a mile. You're already 60 cents underwater and this problem is just getting started. I know, you don't give back freight, that's not who you are. Maybe you can use the awards you'll win from your shipper customers to pay your employees. Shippers, cargo imports, produce season, inventory rebuilds, here we go again. We're not even in Q2 yet and the cargo ships just waiting to unload already have projections for next quarter exceeding last year. Why do you continue to waste everybody's time with routing guide rates 20% below market? Just rip the Band-Aid off already and move those contract rates up. To stay current with everything freight, follow us on LinkedIn. Or for more information on all of our products, including our award-winning freight intelligence platform so your margins don't end up where they are today, check us out at k-ratio.com. Please stay safe, and thanks again for watching.